I'm not sure if my mic is not. There we go. Good evening. My name is David Jaffe. I'm the Executive Director of the IFE. That some of you before, so welcome. The International Association of Financial Engineers, for those of you who do not know, is a nonprofit professional society based in New York for financial engineering and quantitative finance. I think we're celebrating our maybe 17th year. Most of our events are in the U.S. However, we've from time to time come over to London, and we are going to proceed to try to do that more often. So we hope to be back in the fall. A couple quick notes before we get started. First of all, I would like to thank Goldman Sachs for hosting us here today. And I'd also like to thank Primia and welcome the members of Primia. I know some of you are out there, and we appreciate their support. This event will be recorded. The recording will only be on the stage and will not be in the audience. If you ask any questions, it might pick up the audio, but your face will never be on the screen. So don't worry about that. It's been a concern before, so we always say it. And lastly, if you look at the back of your program, you'll see an IFE membership. I would encourage you all to look over it. IFE membership is $200 US a year. I'm not sure what the current exchange rate is. I just got in this morning, but I think that makes it a fairly good deal compared to the pound. $25 for students and $100 for academics. You get discounts to a lot of conferences and access to a wide array of videos of events and discounts to journals as well. So with that, I will turn it over to Giovanni Vegliosi, who's a member of our board of directors and will be moderating this evening. Thanks.
Thank you, David, and thank you all of you for being here with us. It's a pleasure and an honor to be here and to represent the IFE in London once again. It's our first event of the year, but it's a very good one and a very timely one. And certainly, there has been times where financial engineering has been testing its boundaries, one could say, what boundaries we've seen being tested. And I thought I'll start the introduction to the two speakers, which are going to be very short, making a bit of violence to my Italian nature that bring me to talk and talk and talk, with a quote. I won't tell you who the quote is from, but I think you'll recognize it quite quickly. It's from a Financial Times article just a few months ago, and talks about financial engineers and financial engineers. So the quote goes as follows. When you see a quantitative expert, shout for help, call for his disgrace, make him accountable. And then goes on by saying, ask for the Nobel Prize in Economics to be withdrawn from the authors of these theories. And then concludes saying, and this is, I guess, for things that are close to many of us, boycott professional associations that give certificates in financial analysis that promote financial engineering methods. And just to end up with a bang, remove value-at-risk books from the shelves quickly. Please act now. So I guess, again, I don't need to tell you who the quote is from. I can tell you that it's from a person who used to be a financial engineer, a trader. He doesn't want to be reminded that, though, and he's now an ornithologist. He is an expert, in fact, in recognizing black swans. But I claim that he's also very much an expert in not only recognizing cows, but milking them. In any case, the profession of financial engineering is certainly being challenged. And if you, as I did, and I guess many of us did, passed through graduate school in the 90s or the beginning of just a few years back, you couldn't but fall in love with the great elegance of the techniques that were taught there. And indeed, I think many of us fell in love with those techniques that were really applied physics techniques, so the harmony and the perfection of what was there. And you, at least in some measure, wondered whether the perfection had to do with the real world and whether what was being rewarded in academic circles and in business schools was the perfection rather than the likelihood to the real world. Having said that, I think we shouldn't throw away the baby with the bathwater, and I think many of us should be, all of us in fact, should be proud of being financial engineers. And a good example of why comes to me from last week's IFE annual event in New York. And there, another very well-known financial engineer, like the two that we have here today, Peter Carr from Bloomberg, came up with some data that I thought was very simple, again, equally elegant to theorems here and there, but also very effective. And he showed that even a simple hedge on a daily basis of an S&P option using a plain vanilla delta hedge I'm talking about, of course, a plain vanilla Black-Scholes model, gets rid of most of the risk. And what is interesting there, again, is it gets rid of most of the risk. I think we're talking about 85%, hedging on a daily basis. So not certainly not real-time hedging. And it gets rid of about 85% of the risk, but leaves 15% there. So I think the interesting bit is there. Yes, engineering tools, financial engineering tools work, but don't then also point out to areas that are left over, that are left unexplained, and there are many interesting questions there. So in my view, at least, the question is how can we read into the events that we've been through in the last couple of years, and even before, because of course there's been a build-up to those events, make the most of them, learn what we can, without throwing away the baby with the bathwater. And I'll tell you an example, and I'm going to quote one of the two speakers here, David Rowe, and if the quote comes out well, it's David's quote, otherwise it's mine. And he was talking, Dave has got a very long and distinguished experience, not just from an academic point of view, but also from a banking point of view. He was talking about the situation with value at risk, that of course our friend Nassim has just dismissed in the way that I read to you, before value at risk and with value at risk. And what they were saying, yes, value at risk is a number, right? And we all know in reality it's not a number. It's used like a certainty, like a certain number. And that is the limitation of it, and that is sometimes what brings you to the wrong conclusions. But on the other hand, it's a number that gets the trader, the risk manager, and the senior manager in the bank to talk. And it's a number that is shared between them. It may be a flawed number, but at least it's something that was a lot better, that is a lot better than what was before. There was just waving of hands and screaming. So I think with this, what I'd like to say is that it's the place where financial engineering got itself and where do we go from here is a very, very important topic. It's very, very important, as I said, not to throw away the baby with the bathwater. And we have two very, very good speakers here, arguably amongst the best speakers that we could get to debate this. And if you're here, it means that you know Paul and Dave, at least by reputation. And so I don't need to spend too much time talking about themselves and their careers. They're very well-known professionals in our space. So what I'd like to do is I'd like to ask them to give their talks, Paul first, and then Dave. And then we're going to ask a Q&A for both of them together. So I'll ask you not to ask for questions at the end of Paul's session. So without further ado, let me...
Thank you very much. Obviously, I have to comment on about my dear pal Nassim Taleb. I've got to say something, haven't I, in sort of defense. Anyway, I'm not here to praise Taleb or to bury him, for that matter, but he does divide opinion, doesn't he? Some people adore the man, some people, well, the opposite, dislike him intensely, with a passion, even though they haven't met him. Well, equally, I do the same. Nassim and I are kind of the Marmite of this business. You either love us or you hate us. Whether you've met us or not, you love us or hate us. I did meet a couple of people recently who hadn't actually heard of Nassim Taleb and hadn't heard of the Black Swan. And that I must admit, a little bit of Schadenfreude there. It did cheer me temporarily, that thought. But it was only 2 people out of the 6 billion on the planet.
He's been hibernating, right?
Yeah, he's been hibernating. I Googled, before coming here, I Googled Nassim Taleb, as you do. And there are more mentions of Nassim Taleb than are Richard Dawkins. I thought that was kind of interesting, because Dawkins has been around forever in a similar kind of thing, criticizing God botherers. But Nassim has somehow really, really taken things by storm. But I do have issues with Nassim. I agree with him on about 95% of things he talks about. But I do have one little issue, and that is concerning Gaussian distributions and fat tails and things, and how to represent them. Or whether to, how seriously to take the whole fat tail thing. So I wasn't going to say any of this, but I sort of had to because of what went before. My feelings about the whole Black-Scholes model I've been through a lot of different. My relationship with black shoals has changed a lot over the years. If you read my blogs, then you will you've heard, you've read about this. When I first started working in quantitative finance, and this is going back to before the '87 crash, I was in academia, in a maths department. Nobody in maths departments knew about quantitative finance. Nobody knew about stochastic calculus, etc. And I had to do my research kind of in a bubble. So I'd read academic papers, and the academic papers, black shoals, etc., would talk about this thing called volatility, and the volatility was always constant. And so I did some research around on the subject of constant volatility and also the subject of discrete hedging. The Peter Carr work, everybody should know about that. I'll come back to that. They should have known about that for 20 years. I'll come back to that in a second. So when I first started working with black shoals, I believed in this constant volatility concept. And then when I started to get a reputation, doing consultancy, I got access to data, which you don't come across necessarily in academia. And once you start playing around with your first data set, it takes about 10 minutes before you realize this thing called volatility is just not 20%. It's not constant. So my research changed. And it took a completely different direction, which was to try and come up with the world's best volatility model, which I did, if you're interested. But then I started a volatility arbitrage hedge fund. And there we had to value a lot of options very, very rapidly. And even though I had the world's best volatility model, it wasn't fast enough. So I had to use something which is a bit simpler. I had to take a very pragmatic approach. And that pragmatic approach was to go back to good old constant volatility black shoals. By then, of course, I'd researched this field for so long, I knew the pitfalls associated with black shoals. And its good points, its bad points, when it works, when it doesn't, etc. And I was very comfortable working with something sufficiently complicated, not too complicated. I'll talk about that shortly, this idea of the math sweet spot. And black shoals hits that math sweet spot perfectly. So let's go back a couple of years. If I was speaking to an audience of quants, then typically I'd be saying things like, well, black shoals, it's pretty good, but it's not quite as good as you think it is. And the audience would say, oh, no, black shoals is fantastic, or we can make it better, we can improve it by having stochastic volatility or jump diffusion or something. Oh, it's a brilliant, brilliant, brilliant model. And I'm saying, well, actually, those improvements are not necessarily making things better, they're just making things more obscure. They're allowing you to calibrate and therefore actually hide the risks more than anything. Somebody's nodding, that's a good start. If I ever say calibration, I usually get ooh, in the sense of, because I hate calibration with a passion. Anyway, so go back a couple of years. I am saying that black shoals is not as great as people think it is. Go forward to now. I'll speak to the same audience, same people. And I'll be saying, black shoals is pretty good, pretty robust, My position doesn't change. Everyone's saying, oh, no, it's all, you've got to throw it all away, you've got fat tails, fat tails, fat tails. They've all, like sheep, and this is my big complaint about, well, people generally, is they've all gone from one position where they're adoring this whole black shoals thing to the opposite extreme, where they hate it, and they're all going fat tails, led by my dear pal, Nassim Nicholas Taleb, of course. That's the annoying thing. Lots of annoying things. I'm using that word a lot. But the real problem is these people who were worshipping black shoals are the same people now who are trying to destroy black shoals or want to start from scratch. None of them have actually tested black shoals. None of them have actually tried to come up with their own models, tested the model, looked for robustness. It's hearsay. That's the crime in all of this, is that something scientific should not be fashion. There should not be a fashion about whether is black shoals or black. What's the new black shoals, as it were? You should not have these fashions. It's madness. So I just want to say that, inspired by what you said about Nassim. So, fantastic guy, love him dearly. I would have his babies if I could, but I don't go along with absolutely everything he says. Also, you mentioned the Peter Carr thing. I've got a list here of a dozen The thrust of my talk, if I had a day, I would go through the 12 things, 12 utterly, utterly trivial things that people can do to make their financial engineering, risk management, etc., more robust and less dangerous. A dozen absolutely, utterly trivial things. I don't have a day to go through these, so I'm just going to skip about. And I think I'm going to skip to the reliance on continuous hedging arguments somewhere along here. I'll go backwards and forwards until I run out of time, really. That's how it's going to work, if that's okay. Okay, the point is, how many papers have there been on discrete hedging? You mentioned the Peter Carr paper, as if this was the greatest breakthrough in the history of derivatives. That work goes back 20 years. You should all know this. You should all know about the issues concerning discrete hedging. You said that 80% of risk is got rid of by daily hedging. Well, at least 15%. 15%. When people are fine-tuning their mathematical models to n decimal places, and they're ignoring the fact there's still 15% of error because they're only hedging every day. These things you should know about. But how many papers are there on discrete hedging? A dozen or so? How many papers are there on stochastic volatility, improving your volatility model? Calibration, thousands, tens of thousands. Most complete garbage. And don't address the real issue. One of the real issues is getting rid of risk, even in a simple constant volatility world like discrete hedging. You should all know this, and you should not have had to mention it. So I'm glad you did. Here's a little thing, a nice thing. For example, suppose I tell you you're allowed to hedge 25 times in a year. I've got a picture here. Now, this is an example of the discrete hedging thing. This picture is, horizontal axis is number of hedges per year. I think it's an example of a one-year option at the money, a strike of 100, etc. 20% volatility. It's perfect Black-Scholes world, but you're hedging discretely. Horizontal axis, number of times you hedge in the year. And I've got 4 lines on this. Focus, to start with, on the red lines. The red lines are if you hedge at fixed intervals. So if you hedge, say, 25 times, that would be every 2 weeks. Now, obviously, it should go on and on and on, hedging more frequently. The 2 red lines represent a mean plus or minus 1 standard deviation. So when you talk about the 15% hedging error, that's kind of the width of those red lines. Okay? The red lines are hedging at fixed intervals. And most research that you may not know about is about hedging at fixed intervals. So if you do hedge only 25 times in that year, which is not very often, then you've got that big hedging error. It's random, depends on the path taken by the stock. You could make money from hedging error, you could lose money from hedging error. But what if you asked a question about how to hedge optimally? Suppose I said, look, I'm giving you 25 hedges. You don't have to use them at fixed intervals, because most of the maths of fixed interval delta hedging is trivial. But what if you hedge at other times? You get to choose. Well, that's what the green lines are. The green lines are hedging optimally, in some sense. Again, mean plus or minus a standard deviation. And what you see happening is, with 25 hedges now, it's reduced enormously if you hedge optimally. So all this business about hedging, discrete hedging, and risk neutrality. People using Black-Scholes models, risk-neutral models, and even if you're hedging every day, you've got 15% error. Well, can you really justify using the whole risk-neutral kind of argument if you're hedging only every day and therefore have got 15% error? It looks a bit dodgy. Looks a bit dodgy to me. That really, if you're going to use Black-Scholes risk-neutral kind of arguments, you must be hedging, I don't know, every minute. If you want to really justify it, you have to hedge a lot closer to continuous. That's the point. Most people don't know about the mathematics of discrete hedging. Those who do know that actually you've got quite a lot of error, the 15%, for example. So you shouldn't really be using risk neutral. So the point is you should not be using risk neutral because of the size of those hedging errors. However, if you know the next level of mathematics about optimal hedging, then you can get rid of the risk make it tiny, even with a relatively small number of hedges. So the conclusion is, yes, you can use Black-Scholes, risk-neutral. You can use risk-neutral arguments because the green line's so close together, but only if you know about how to hedge optimally. Okay? So the question becomes, how many people here know how to hedge optimally? Those people are allowed to use Black-Scholes. No one else is. Okay? That's the punchline. But that's one of those things. It is so important, but a dozen papers compared with the 10,000 on stochastic volatility? It's crazy. Absolutely crazy. Let me go back to my list of things. And we'll pick a few other things. Correlation. Should we do correlation? Disclaimer about correlation. You want to know what the world's best volatility model is? I can tell you. It might cost you something, but I can tell you. How to hedge optimally? I can tell you how to do that. Everything here is essentially a solution to a very simple problem. The one thing I cannot solve, I have got no solution for, is the problem of correlation. That is a big, big problem. There is no nice way to value things that depend on correlation. So I have to, at the moment, I have to say I have no idea what to do. But I'm going to just talk about correlation for a few minutes. The correlation. If you've got something that depends upon multiple underlyings, a CDO, for example, swearing, no, the C word, what do you use to model the relationship between things? Well, the only thing that's in the quant toolbox, really, is this thing called correlation. And correlation is the clumsiest tool, really, for capturing the subtle dynamics between things. For example, a classic trick question I often ask people is, if you've got a correlation of 1, you've got two stocks, perfectly correlated, correlation of 1, then they move in the same direction, right? I mean, they move, if one stock is worth 100 today and the other one's worth 100 today, and then one of them is 200 in a year's time, and they're perfectly correlated, where will the other stock be? So both stocks start off at 100, one ends up at 200, they're perfectly correlated, where will the second stock be? And everybody, not everybody, but 90% of people say, well, it'll be at 200. Perfect correlation, they do the same thing. Well, it doesn't mean that. To the quant, correlation is about what happens over the finest possible timescale. And you care about fine timescales because of all the hedging that you do. You don't care about long timescales. It's what happens from one hedge to the next. So you can have two things which are perfectly correlated, but going in completely opposite directions. And similarly, you can have two things which have got correlation of -1 and going in the same direction. So correlation, first of all, doesn't capture the kind of things that people instinctively think it does capture. Another thing is, correlation is, I like to tell the story of Nike and Reebok, and this is just a completely made-up story, but it captures a lot of dynamics between two companies very well. And this is, Nike and Reebok, they both manufacture running shoes, and parents want to buy running shoes for their children because they're sick of their children sitting in front of PlayStation and Bebo and things like that, so they want to get them out on the street. So parents buy Nike and Reebok running shoes. Then Nike hires, I've got a pointer thing somewhere. Anyway, Nike hire some American baseball player to promote their wares. So the children, they want the cool Nike products. They don't want Reebok products. So Reebok fall and Nike rise. That's the sort of regime too, if you can see that. Then it turns out the American baseball player is a drugs cheat. Surprise, surprise. So the parents don't want to be seen buying the Nike products, so the Nike price levels off and they start buying Reebok and that comes back. And then an advocate of jogging is out jogging one day and he falls down dead of a heart attack. You're all far too young to remember that particular incident. A man called Jim Fixx. Parents think, actually, this jogging, this exercise, being in the streets, knifing, UK being the most violent country in Europe, they're much better staying in front of the TV, PlayStation, Bebo, etc. So they stop buying running shoes. Now, see the relationship between these two companies, Nike and Reebok, the same business, but sometimes they're going together because they're in the same business. They're both going up together when everyone wants to buy running shoes. Or they're both going down together when people stop buying running shoes. But equally, because they're in the same business, they compete with each other. So sometimes they'd be going in the opposite direction. I run various businesses. There's nothing I would like better than my competitors to do badly. Okay? So sometimes you get things going together, sometimes going in opposite directions. And you know, this is all supposed to be captured with rho equals 0.6. What were people thinking of when they came up with these ideas? I can understand you've got to do something, but this is such a stupid model, that you really don't want it to be doing anything with correlation in size, because it is just downright dangerous. CDOs, CDOs are fantastic, fantastic products. They will return, just like big bonuses are coming back already. And you know, we've all got distracted by MP's expenses and swine flu, etc. CDOs, they'll be back. Well, they're very good instruments. The way you take all this different risk and put them together and slice and dice, you can take whatever level of risk you want. Fantastic. The problem is modeling them. You've got 1,000 different mortgages. So you're going to have how many, if you're dealing with correlation, how many correlations have you got? Well, 1,000 times 999 divided by 2, you've got 500,000 correlations. Who's going to measure 500,000 correlations? Okay, let's assume they're all 0.6. So you start off with some complicated, you know, copulate kind of model, really fancy mathematics, and then you say 0.6. I mean, what is going on there? Absolutely insane. So anything to do with correlation, you must avoid like the plague. Or if you've got something that depends on correlation, either you come up with a theoretical value and then you multiply it by 2, give you a nice profit margin, you know, margin for error. Or you just do it in small sizes. You don't do what typically happens is, oh, CDOs, we're all making lots and lots of money from CDOs. Let's do 10 times. Let's do 100. Let's do 1,000 times as many. Bank next door does thousands of these things. Every bank is doing thousands. Bid offer spread shrinks, so there's no margin for error anymore. And when things go wrong, every bank is doing the same trade, and no banks have got any margin for error. Everything blows up. Absolutely insane. It's criminal, really. So correlation is just awful. Oh, one of my favorites. Sensitivity to parameters. Right, you'll all know the answer to this question. I hope you know the answer to this question. If I increase volatility, what happens to the value of an option? Don't be shy. You've all got microphones, haven't you? You increase volatility, what happens to the value of an option? Huh? Who says goes up? Hands up if you... I've heard a few going up. All right, hands up if you say it goes up. It goes up except when it doesn't. Anyone want to say anything different? Does anyone say it goes down? Anyone says... What's the person says it goes down? Anyone say it stays the same? Any other answers? Who says that? Good. Who says it depends? Okay. Oh, now everyone says it depends. That's fun, isn't it? Where were you before? See, sheep. Sheep. Okay. How many purple ties have we got? You notice how ubiquitous purple ties have become on politicians. Anyway, the answer, it was a trick question. The answer is it depends. You take something like a barrier option. My favorite example is it's good for everything, really, is an up and out call option. And the way this works is that's value against stock. And I've got two curves for this up and out call option using different volatilities. The more peaked one has got 17% volatility, and the other's got 23% volatility. And the it depends thing is about what sign is gamma. If gamma is everywhere and always positive, then increased volatility, yes, the value goes up. If gamma is everywhere negative, then increased volatility value goes down. If you have gamma positive somewhere and gamma negative, then some places it goes up, some places it goes down. And so you get a situation like this, where you change volatility from 17 to 23, from the blue to the red, and some place it goes up, some place it goes down, and in the middle it crosses over. Now, if you happen to be in the middle at around about 80, valuing this thing, and you do this sensitivity to volatility thing, you say, oh, Vega, you know, it's 0. I haven't got any sensitivity to volatility. That's completely the stupidest thing ever. Because what you've done there is you've taken constant volatility and you've changed it, you've varied it. Okay? Constant volatility to get each of those curves, and then you varied it. Now, you can do lots of things with constants. You can add them, multiply them, subtract, take, raise them to powers. The one thing you're not allowed to do is change them. You're not allowed to vary constants. So you get into this mess. Because actually, if you have more richer models, you'll have you can get a much wider range. For example, here I've got a picture of volatility being between 17 and 23%. The blue line is still 17. The red line is whatever the middle line thing is 23. The bottom red is a positive skew, and the green is a negative skew. So you get an enormous range. Actually, see that point at around 80, the S equals 80, where the two lines cross. That's where you think Vega is equal. Well, Vega is equal to 0. You think you've got no volatility risk. But look at the range between the red line and the green line. There's a factor of 3. Okay, a factor of 3 in the value. I'll say it again. Factor. How many basis points is if you're in fixed income, you make half a basis point profit, break out the champagne, right? Here, you've got a factor of that's 30,000 basis points. That's the sort of risk you really have. And if you measure Vega, you're completely missing the point. Completely missing the point. That's why I've christened this recently. I've given it a name. Have I got the name here? I've called it, I hope there aren't any people of Greek persuasion in the audience. Any Greeks? Good. Because I started calling these things, anything where you vary a constant, which is naughty, those sort of Greeks I've called a bastard Greek. So that's my northwestern accent coming out. Bastard Greek. Okay? Because they're illegitimate. You must not do dV by d sigma. Anyone who does dV by d sigma should be, strung up. Very dangerous. You see another example of that. One thing that comes out from this, if I plot the value of this barrier option at the stock price 80, as I vary volatility, you'll see this picture happening. You'll see value versus volatility, constant volatility. It's non-monotonic. Now, if that was a call option, it would be monotonic. And that would be fine. Then you can measure Vega. But if you ever see that picture, it means sometimes volatility is good for you and sometimes volatility is bad for you. It means there's something subtle going on in volatility terms. If you see that, you must never measure Vega. Do you ever see that? I've got an example here, somewhere. You see that mezzanine tranches of CDOs. You know this thing where people, they say, CDOs, I've got all these 500,000 correlations, so let's assume they're all 0.6. And then they say, oh, what if it's not 0.6? So they vary the 0.6. They make it 0.5 or 0.7. And they think they're doing risk management. They think they're doing something clever, stress testing or whatever. Rubbish. Almost swore then. Rubbish. That's what they're doing. You see that you've got this non-monotonic behavior in this mezzanine tranche thing. And as soon as you see that picture, you immediately say, this contract is dangerous. These are absolutely trivial things that you should know about, like you should know about the 15% thing, the discrete hedging. All these things, utterly, utterly trivial. And I guess you've all got masters in financial engineering, haven't you? That's all I blame. I blame all these measure theory police. Oh, good, someone hasn't got a master's in financial engineering. There's hope for you, sir. Everyone else they're lost. What else have we got? The main thing I complain about is too much complexity in things. And I've blogged about this math sweet spot. The math sweet spot being the idea you don't want to have the mathematics too basic where you dumb things down. You don't have the mathematics too sophisticated because you can't see what's going on. If you make things too complicated, then, well, nobody understands what's going on. The number of papers where some academic who's never traded in his life come up with some model and it's been implemented by quants who, for example, don't know about complex or integration in the complex plane, implement these things and make mistakes. Happens all the time. Too much complication, nobody has a clue what is going on. I blame all those yellow books, you know, the ones I mean. That was a maths in joke, you know, the Springer books. Too much mathematics. Crazy, 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 absolutely crazy. You want models which are robust, which are transparent. You know where they go wrong. You can mend them. It's like the London to Brighton car rally. You know the thing where they have all these cars that are pre-1905. And you set off in one of these things, and you know you're going to break down halfway. But you get out of that car, you get underneath the car, usually your lady friend takes off her silk stockings and uses it as a fan belt or something, or you get out a hammer, you hit it, and you're off again. And you get to Brighton. Anyone seen the film Genevieve? Nobody's seen the film Genevieve? Sorry? Still a brilliant film. But the analogy, you get it at one of these fancy supercars. In my garage in West London, there's a Bugatti Veyron just in the garage. You get in one of these supercars, and you get you drive to Brighton. If you break down, then it's going to cost you, I don't know, 10 grand to get the thing mended. And you're not going to get to Brighton. You're going to have someone tow it back to your garage. And 10 grand, a month later, you get to drive it for 15 minutes before it blows up again. That's the analogy. You should be working with simpler, robust models. You know where these things break down. It's like the Goldilocks thing, the porridge not being too hot or too cold, but being somewhere in the middle. So, anyway. Just a few more minutes and then I'll stop. What else? Feedback. I just mentioned this because this ties in with a student of mine, a very, very brilliant student, a guy called Philip Schornbucher. You've probably heard of him because he wrote that book on credit risk. Okay? I blame him personally for the recent crisis. Actually, not really. Joke, okay? If there are any libel lawyers, slander lawyers, etc., that was a joke. I don't blame him. I'm serious, I don't blame him. But he was my student, and we worked on the feedback effect. This is brilliant stuff. This is about how the hedging derivatives can move the underlying market. Because there's, $1.2 quadrillion outstanding notional of all derivatives. World economy, 50 trillion. Slightly frightening, no? So people hedging derivatives is going to move the underlying market. People say, well, derivatives, it's a zero-sum game. Everyone who buys, there's a seller, right? They cancel. Well, no. Somebody buys, somebody sells, maybe hedging, and therefore the moving market. Suddenly, people are buying and selling IBM stock, not because they think IBM is going up or going down, but because some quant with a formula says this is how many you've got to buy or sell to hedge your IBM options. It's madness. It's madness. Feedback. Anyway, so Philip Schornbucher and I worked on this feedback effect thing. Did some great stuff. Then he went off and he got corrupted and he wrote this book on credit risk, which is crazy, crazy maths, crazy maths. I have to take some blame for this for the recent crisis because I did write an endorsement for his book on the front of the book. But since he was a student of mine and a friend of mine, I kind of felt I had to. Even though when I was writing that endorsement, I thought, this is too mathsy. And I speak as a mathematician. I am a mathematician, always have been a mathematician. But I'm still saying you're using the wrong type of mathematics. If you're in valuation, if you value stuff, you're a quant who values things, you're using too much maths. If you're in risk management, you're using too little maths. Somewhere in the middle, okay? And you should all know about anyone who said that when a volatility goes up, option goes up, then you're using the wrong sort of maths. You should draw the pictures. I think I'll stop there. Unless there's any particular one anyone wants to, that you see there?
You still have time.
Still have time. Votes? What do people want? I knew it! Who said calibration? Calibration is the devil's work, okay? And you don't know it. You don't even realize how bad calibration is. Calibration is wrong and bad on every single level. It's wrong and bad on the mathematical level. It's an inverse problem. If you know about inverse problems, right? You know about the mathematics of inverse problems. You'd never find an applied mathematician who could look at this with a straight face. When I first saw, and Emmanuel Derman, Bruno de Pia, Mark Rubinstein, when they came up with the deterministic volatility model in '94 or so, the three groups published simultaneously, I looked at that and I thought, no one will take this model seriously. 15 years later, I am still fighting to have this, to stick the stake through its heart, or the silver bullet. It's bad because, first of all, for mathematical reasons. numerical reasons to do with instability, you know, anything, any inverse problem is bad from that perspective. But also, it's the underlying assumption that you have. Let's take this deterministic volatility model. That volatility is a function of stock price and time. Crazy, crazy, crazy assumption. It does, you know, does not. You test this, it doesn't work. So if you're calibrating, you're making this. You're taking a snapshot of how the world is, and then you're saying that's how the world is going to carry on. But when you come back to calibrate a week later, well, it's not called calibrating, it's called recalibrating. And why is it called recalibrating? Because you have to do it again, and it's different from what you did last week. That tells you it was wrong. It doesn't get any simpler than that. It tells you it was wrong. And the reason why it is wrong is because people are strange creatures and they don't value things consistently. One week they're valuing things in a certain way, the next week they're valuing things, option pricing in a different way. It's not consistent with this volatility being a function of stock price and time. I could go on for hours about this, but I'll give you an analogy. Miami, CSI Miami. Who watches CSI Miami? Oh, God. You haven't seen Genevieve and you don't watch CSI Miami. Come on, who watches CSI Miami? Don't be shy. Did you see the last episode? Did you know that was going to happen? You did? Well, it's new here, isn't it? Shall I spoil it for everyone else? You must have seen the trailers for it. Did you see the trailers for it? Well, they killed off Horatio Caine. Huh? Doesn't mean anything. Well, I'm going to spoil it for you. He wasn't dead. Okay? They didn't kill him off. You're not surprised. Okay, well, I fell for it anyway. But a few episodes, there was one episode of CSI Miami where there was a murder on a yacht. And they had a clue. And the clue was that they had a piece of fabric from the sale of the yacht. Do you remember this episode? No? And on the fabric, there'd been some writing. It was the name of the murderer. Or something. But this fabric had got wet. And the ink had diffused. So you couldn't read the name of the murderer. So they took it back to the lab. Beautiful lab, no? And they put it in one of the CSI Miami gadgets. And they did some computer stuff with it. And they undiffused it. They managed to make the ink go backwards. Now, if you're an applied mathematician, you know about inverse problems, you know about diffusion equations, you cannot do that. That cannot be done. I lost all respect for CSI Miami at that point. But it's actually not that bad. It's not that bad, because if you know that on the fabric it's letters, and there are 26 possible letters, and it hasn't been diffusing for too long, then it is possible to go backwards within a certain degree of accuracy. So that's not too bad. But you try and do the same thing with this deterministic volatility model or any calibrated model. It doesn't work because the model in the first place was wrong. This volatility, a function of stock price and time, is wrong. You calibrate, you find a function, you come back a week later, the function's changed. The function's not supposed to change. So you should stop calibrating immediately. I want to show you the last picture is the reason why calibration doesn't work. It's my favorite picture. Quant finance. Somewhere. Here it is. This is a thing called the market price of risk. It's actually, you know the market price of risk. It is how much compensation you need for taking risk. And this is the market price of interest rate risk. Everything that's random has a market price of associated risk. Associated market price of risk. So this is the market price of interest rate risk. And if you read the books, well, most books, not my books, but other people's books, you read the books, you think this market price of risk thing it's a nice economic idea. It's probably got a value of 3, okay? Because people are such wonderful, rational people, aren't you? You've all done your own internal market price of, utility functions thing, and you've come up with 3. Well, you look at it, because you can back it out from the data in various markets, and you see it's not 3. It's not a constant. It seems to jump about a bit. You know what it's like? It's like people sometimes panic, and sometimes they're greedy. People's emotions change. That's what a revolutionary idea that is. That's what this says. When it's peaked down here, that's extreme fear. Sometimes the market price of risk has the wrong sign. In other words, people are paying to take risk. All these rational people. What? Is this Las Vegas? Is this a roulette wheel? Then people pay to take risk, but they shouldn't be in this efficient, rational world, right? It bounces around. So when you do this calibrating, you're taking a snapshot at some point in time of what people think the future holds, including their market price of risk going forward. And if you take a snapshot when they're fearful, then you're assuming that thereafter they're always going to be fearful. Well, what if they stop being fearful? Which they will. Well, it doesn't take long, does it? A week or two? People go back to normal. Oh, what was all the fuss about? Right? The swine flu in Mexico, I was in Mexico not so long ago, and they said that when the swine flu first came out, everyone was wearing masks. After 2 weeks, they all stopped. Okay? People get over these things within 2 weeks. But that's what you're doing when you're calibrating. You're taking a snapshot of a crazy market and assuming that craziness goes on forever. And you come back a week later, the craziness has gone away, you recalibrate. Why did you do that? It was wrong. All right, I'll stop now. Okay.
I knew when I was speaking after Paul Wilmot that I was in trouble. I mean, there's very few harder acts to follow. I must say, though, it is someone like me who's kind of a pretend quant. It's very satisfying to see someone with Paul's stature calling into question some of the basic sacred cows, because he does it from a lot more solid platform than I. I'm going to go through these slides pretty quickly. A lot of what I do at SunGard is to try to be a voice to risk management in general, not just the quant risk management. And about 9 to 10, 11 months ago, I started thinking about what were the lessons we should draw from this very painful experience we're going through. And I basically came up with 5. I mean, I'm not as imaginative as Paul. He's got 12. What can I say? But there's I'm sure that's true. Some of these will resonate with things that you saw on Paul's list, however, which makes me somewhat satisfied. The first one I call statistical entropy, and I'll talk a little bit about what I mean by that. I used to call it the law of conservation of information, but I've gotten more pessimistic in my old age. Second one is structural imagination, the importance of trusting and actually relying in many respects on or pressing your structural imagination. Third one is self-referential feedback, these kinds of loops that Paul was talking about. Fourth one I call complexity and dark risk. I used to call that secondary uncertainty, which is the second order uncertainty, which is the title of one of the columns that I passed out on the desks. It was actually Stuart Turnbull that said, no, you shouldn't call it that. He said you should call it dark risk, because he said you call it secondary uncertainty, i.e. the uncertainty around the parameters of your stochastic process, which aren't constant, as Paul pointed out. That's really where the true action is. And he said, but you call it secondary uncertainty, you say that to anybody on a congressional committee, and they'll say, oh, secondary, that's not important enough to worry about that. So, I mean, he said, no, you should call it dark risk, which would probably be a lot more threatening. And the fifth one is the importance of an alternate means evaluation. So I'll try to do this in about 25 to 30 minutes. I'll be speeding through a lot of this, but key point number one, we always must remember, statistical analysis can extract information from data. It cannot create information. Another way of saying that is that, like water, information can never rise higher than its source, and the source is the data. We start out, frankly, we're swimming in data. See, I spent 13 years as a talking head macroeconomist, and then I went into financial risk management. And a lot of people say, gee, that's kind of very different, what you used to do and when you shifted out of forecasting. I said, no, I don't think of it that way. I think the consistent thing of what I've done throughout my whole career is to try to take data and turn it into information that is meaningful to make better decisions. The point being, we build models, we do statistical analysis, we use math in various ways. The idea is that we are extracting usable information from this sea of random data that really means nothing to us. But we, at our peril, start to think that we've created information. Now, very few people would say that to you explicitly, but you don't have to go to too many conferences to see some very complicated analysis that implicitly, if you're not careful, you walk away unconsciously thinking that somehow this process creates information, and it's never true. So don't ever fall for that. Now, thinking about the subprime mortgage market, supposedly the criteria for AAA is slightly different in the different agencies, but one criterion is that the probability of any failure of timely payment of principal and interest over a 12-month period is less than 1 in 10,000. 1 in 10,000 years. I did this presentation recently in Beijing, and I said, you know, that's a pretty dramatic claim. That's twice the written history of China, which has the longest written history in the world, right? 1 in 10,000. That's a pretty dramatic claim. Now, the amazing thing is that some of the super senior tranches of these subprime things were supposedly better than AAA. So the question is, what kind of empirical basis do you have to make a judgment like that? Well, I did something, and please don't jump on me. I know this is not just simple, it is utterly simplistic, but I thought, let me just do something really simplistic and see what I come up with. This chart, the top line is foreclosures as a percentage of outstanding mortgages for the subprime category of mortgages. That's the big wavy line, the dark blue one. I said, well, what if I took, these are quarterly data for 10 years. I said, what if I know this is very simplistic, don't jump on me. I said, what if I took these as a proxy for annual defaults, just to see what happens? So let's just pretend I've got 40 values, these are annual defaults. You see, I mean, it's basically 6% at the mean, and it fluctuates around. And I said, okay, what if I tried to create a probability distribution out of this? I said, oh, you know, you have to have a distribution that's bounded at 0 because defaults can't be less than 0, so log normal distribution is kind of a good candidate. So all right, so I got mean is about 6, standard deviation is a little over 2. What do I get if I do a log normal distribution with those parameters, and I get a curve that looks basically like that? So I said, okay, now how far do I have to go out that axis? How much subordination do I need to get to 1 in 10,000, 1/10,000 the probability that falls beyond that cutoff point? And lo and behold, what did I find but 20%? Now, you know, the market, that's not too far off from where they started to assign AAA ratings to tranches. If you were sort of had more than 20 to 25% subordination, that's about where it started to kick in, interestingly enough. But in fact, if you saw the chart, the biggest observation I had in that to look at was less than 10%. What we've done out here is to try to say something about the extreme far end of the tail on the basis of some kind of distribution we fit to the middle of the distribution. Now, Nassim Taleb is the topic of the night, obviously, and those of you that have read the Black Swan know that someone like me, who's a former econometric model builder and forecaster and a builder of VAR models, you have to be sort of tough-skinned to put up with Nassim, right? But actually, Nassim and I like, on my side at least, I think we get along pretty well. I have a little bit of immunity because 2.5 years before the book came out, one of my columns in Risk was entitled Operational Risk in Black Swans, and I'd seen his stuff on the internet, and I knew at the time he was really onto something. And I reminded him of that about 6 months ago, and he wrote back in an email and said, yeah, he says, yeah, you figured that out a lot sooner than I did. I had no idea it was going to be this big. Anyway, one of the things that Nassim says, and it's absolutely clear, he said, just studying the middle 99% of a distribution, especially in social scientific systems, tells you virtually nothing about the behavior of the tails. And that is one of the central truths that I think he has hammered home to us that we all need to keep in mind. Now, in fact, for a long time, this process worked pretty well, because one of the things they did in these portfolios is they got a lot of geographic distribution from different parts of the U.S. So there have been regional downturns in housing. I've had the misfortune to sell a house into 2 different ones, one in New York and one in Silicon Valley. So I know that regionally house prices do fall in the U.S. Apparently, if you look at the data, things hadn't actually fallen in the U.S. nationwide since the Great Depression, home prices overall. Now, why does this work? Well, it works because the reason you get those defaults that you saw on that chart are because of reasons that are idiosyncratic. You basically, it might be the death of the primary breadwinner. It might be a property or casualty loss that is uninsured. It might be a major medical bill. We all know about the shortcomings of the U.S. health system, okay? The question is, what unobserved contingency could disrupt this? Well, essentially, the threats to diversification, there's one that was pretty obvious. Everybody talked about it. And that was if you got an overall fall in housing prices, everybody knew that was going to have a significant impact across all of these portfolios. That is, remember, we all know the central limit theorem. You can have lots of random variables. You get enough of them, you add them up or you average them, you get a nice bell curve, provided the underlying random variables are statistically independent. When that assumption goes away, hello, it doesn't work anymore. So, in fact, wouldn't you think we should maybe look at home prices instead of just saying, oh, home prices never fall? Well, this is the Case-Shiller 10-city index starting in beginning of 1995. Now you can see it was basically pretty stable around 95, then started to rise, hit 5, hit 10%, got to 15, dropped back down a little, got back to 15, actually got to 20, and then started to taper off pretty rapidly in the far end, sort of 2005, 2006. Interestingly, if you look a little bit, remember, we're talking 1 in 10,000 years, right? This is a pretty dramatic kind of claim. Look back before 1995, you know what you see? Hello, we had 3.5 years of pretty soft home prices in the U.S. on a 10-city index. This isn't nationwide, and prices didn't fall completely nationwide, but to say home prices never fall is being a little cavalier under the circumstances when you're talking a 1 in 10,000 kind of estimate. What's even scarier is if you, instead of looking, that chart is actually, the red line is a 12-month, essentially, it's monthly data, percent change from the same month prior year. So what if we look instead at month-to-month change? Well, near the end, it looked like that. Month-to-month, annualized, we got over 20% in September of 2005, and then it started to drop pretty rapidly. Prices are still going up, right? Percent change is still positive. But in fact, if you look out here at the far end, we were down to around 5% by 2006, and even more dramatically. Look at the last 6 months. That's the last 6 months of 2006. Home prices were falling in absolute terms. The percent change had turned negative and was negative for 6 months at the end of 2006. I have a good friend who's the chief risk officer at one of the big U.S. Academic pension funds. I asked him in December 2007, well, how are you doing in the midst of all this upheaval? Well, he says, you know, we're feeling pretty good. We sold all of our subprime holdings in the second half of 2006. And they had pretty sizable holdings. They sold them out in 2 days. Hardly a blip in the market. I mean, that's how liquid the market was. So the point is, you really had, and by the way, some of you know the story about Jamie Dimon, who apparently went on the warpath in the second half of 2006, or fourth quarter of 2006 in particular, and said, we've got to cut our exposures. And I'm sure it was partly this, it was partly information he was getting from the retail banking side that said we're getting very surprising increases in late payments and foreclosures. And he began to realize that something was going on and they had to do something about it. So there were early warnings, and I think that, to me, the second one is trust your structural imagination. Think about some of these feedback things that in this case, was not all that hard to imagine or hard to think through. At least don't allow yourself to be dismissed, oh, that never happens. At least start to track the data. The data in particular that might exhibit things that were not in the historical sample that was used to create the risk estimate. I mean, to me, that's kind of the key thing. Okay, self-referential feedback. Paul alluded to some of this. Many developments, in many respects, have the seeds of their own self-destruction. And I think the huge expansion in subprime mortgage debt set the stage for a far more serious crisis when conditions ultimately began to worsen. If you look at this is originations of subprime mortgages in the U.S. These are annual data starting in 2001. The originations were about $150, $200 billion. They were 6 to 7% of total mortgage originations in the U.S. at that point. By 2005, 2006, they had essentially tripled to $600 billion, 20% or more of total originations, and by some estimates, by the end of 2007, 14% of the total outstanding stock of mortgages in the U.S. were subprime in character. Now, it seems to me, and again, this resonates a bit with something Paul said, there's two destructive self-referential feedback loops going on here. One is A unique innovation generates attractive returns. Paul says, yeah, works for a small thing. Well, no, we'll do 100 billion, now we'll do 200 billion, now we'll do, I mean, the point being, what do you do? If it made money the first time, you do it again. Other people catch on. Other people do it. Volume starts to grow. Well, in this case, you had to keep supplying mortgages. You had to have things to package. So how do you get more mortgages? Well, you lower the underwriting standards. That's one of the things that happened. The other thing you do is you make it more complicated. You repackage and recompound the process. So you do it synthetically. So you create complexity, which is really in many respects gratuitous, just to drive the demand for volume. Now, in effect, what that does is that, remember, the risk estimates that rated these things AAA were based on a certain period before this huge thing took off. And what happens is that the structure of the underlying market, this is the sort of dark risk thing, starts to diverge from the sample period that was used to generate the data to create the risk estimate in the first place. So unfortunately, it doesn't kick in right away because the obvious visible volatility is not necessarily immediately affected. So the growth continues, and you keep getting this till a point you get this significant divergence of the structure of the market from the long-term sample data that was used to create the risk. Eventually, you get to the point where that pressure builds up and it breaks loose. It's like bending an iron bar. It bends for a while, you can bend it back. Do it enough times, at some point that you can't predict, it fails catastrophically. And that's the kind of thing that I think was going on here. The second similar but related feedback loop is when you had an initial economic shock, and my own candidate for that was the run-up in oil prices that squeezed working-class household budgets in the U.S. That began to generate a slowing in house price appreciation, as you saw in that earlier chart. Eventually, it led to house prices actually falling. That phenomenon resulted in larger defaults by virtue of the fact that the outstanding volume of mortgages we'd created in this splurge was actually bigger, so that this problem was unfolding against a backdrop of much larger outstanding exposure than would have otherwise been the case. That meant bank losses were greater, bigger impact on the bank earnings. That meant banks pulled back faster. They started to foreclose on more mortgages. And of course, what do you do with a foreclosure? You got to dispose of it, so you put the house on the market, which does what? It reduces home prices, and you get this kind of process feeding on itself, ultimately leading to a significantly compound economic impact. Fourth, and I just have one slide on this, but I love it, and you have to love Google. In my business, you have to love Google, I can tell you. I wanted to have a graphic for complexity. So I went to Google Images, and I typed in complexity. And this is the first thing that came up. This is wonderful. If that is not the perfect graphic for complexity, I've never seen it, okay? My point is, when you have something which is, in many ways, unnecessarily complex, gratuitously complex, and you have limited data from which to derive empirical evidence about how this complex entity behaves, ultimately, you have this dark risk. You have a thing going on where you just don't have the wherewithal to get any real sense of where and how it's going to behave. And this is essentially, I think, the beware complexity is my answer. I'm not one, I mean, I'm fond of saying, kind of quipping a phrase from, bastardizing a phrase from Ken Galbraith, actually, but I mean, to its great discredit, the world is a complicated place, right? But it doesn't mean that you have to create gratuitous complexity, because many times I think that's done just to sort of muddy the waters and increase the spreads, but that's another story. Last lesson, alternate means evaluation. As I said, I transferred out of economic forecasting into banking in sort of mid-career, and I'd never been trained in bank credit methods, and I began to encounter credit people for the first time, and I began to hear an old recurring mantra from credit people, and that mantra was, what is the second means of repayment? And the point is, you make a loan to a company or an individual or a household, your first means of repayment is what you think are the income prospects of the company or the individual. If it's an individual, it's, do they have an education? What's their salary? What, relative to the mortgage payment, what are their future prospects? That's your primary means of repayment. But, oh, by the way, you do get a lien on the house, right? You do have a way that you can seize the house and claim the house, sell it to get your money back. So that's your second means of repayment. Well, I think in the capital markets, and this again gets to the whole issue that Paul was talking about in terms of correlation, is that we need to think about what is the second means of valuation, because I think that's something that people just neglected significantly. I'm going to skip this. This is because we're getting late here. My point here is just to say that when liquidity dries up, prices become obscure. There's a little bit of shakiness around taking prices that we observe on marginal transactions and applying them to the entire outstanding stock of anything anyway. That's a little bit of a shaky exercise. And particularly when prices start, those transactions become thin markets and there's all kinds of other stuff going on, and you're now trying to apply that to a total outstanding stock, that you're kind of asking for trouble. Now, for at least, well, not that long actually, 4 or 5, 6 years, we've had this concept of level 1, level 2, level 3 assets, right? Level 1 assets are observable prices in active markets, pretty straightforward. Level 2 assets, observable prices in inactive markets or observable inputs to generally accepted pricing models. Level 3 is few or no observable market prices, models requiring significant unobservable inputs. My contention to you, and actually most institutions have policies to restrict the amount of your assets, let's say relative to your capital, that are in these hard to value categories. There was a problem though. If I take interest rate swaps, single name credit default swaps, corporate collateralized debt obligations in 2006, let's say, and subprime collateralized debt obligations, I would contend, and I believe it's correct, that these were all level 1 assets. There was huge liquidity in this market. I mean, people were treating subprime investments as a sort of monetary alternative with a sort of better than the competitive yield. And as I said, big U.S. pension funds sold out their entire holdings in 2 days, hardly moved the market. That's the kind of liquidity you had. So you could have had restrictions based on these categories, wouldn't have been effective because these things weren't level 2, level 3. My argument is we need to expand this one-dimensional chart to a second dimension, which is, this is the ease of current valuation, but we need to think about what would be the ease of valuation if liquidity dried up. And so the question is, going back to 2006, where would these 4 categories have gone? Well, I would contend that basically interest rate swap, got ahead of myself. I also think accountants have not really been imaginative enough. I think we should have another category on the table, which is, I call level question mark. That's, roughly speaking, put your finger in the air and take a guess, okay? Now, where were we in 2006? I would contend interest rate swaps, they're all going to be in the first row, right? Because that's, in 2006, they were all level 1. I would contend interest rate swaps were basically level 1 with the potential to fall to level 2. If you can get a yield curve, you can back out the price of most basic interest rate swaps. I would contend, a little bit more contentious, but I would say single name credit default swaps, I would put in that same category. Not quite with the same confidence I would interest rate swaps, but remember, single name CDS started by being priced off the credit spreads in bonds, because that is an indication of what people think is the credit riskiness of the thing relative to, let's say, sovereign debt. So it's a little tricky because IBM doesn't have a bond. It has a whole debt structure with different coupons and different maturities and different call dates, and so you kind of had to back out something that was a kind of representative interest rate spread to try to back into a CDS price. But there is at least something, as long as bonds are trading, there is something you can go on. I would contend that corporate collateralized debt obligations were level 1 and would fall to level 3, again because of this correlation problem. Implied correlation is an artifact of liquidity. When liquidity goes away, what are you going to fall back on? Well, the only thing I can think of is something like distance to default, time series, trying to look at something like that. That's a much shakier foundation to build on, but it is something. The problem, I think, with the subprime mortgages, literally when liquidity dried up, they fell completely off the chart, or would have fallen, and we should have been recognized. What would you do? You really had no basis to back into some kind of a matrix pricing or some kind of an alternative similar sort of thing. And I think in 2008, that's kind of what happened. I think CDS probably are, at this point, more or less level 2 in many cases. Corporate CDOs, in many cases where the liquidity is pretty thin, are largely level 3. But this problem, I think, is that the subprime literally fell off the chart. And one of the problems was that because they were just thought of as AAA money market instruments, banks had tanked up on huge amounts of these things. I did one estimate, this is now about a year old, almost exactly a year old in fact, but my estimate a year ago was that there was about 500 to 600 billion of subprime mortgages still on the banks of U.S., still on the books of U.S. banks, at a time when the equity was about 1.3 trillion. So what we're saying, if that's anywhere close to accurate, it sort of makes sense because I think if it's in the same order of magnitude as the first TARP program. So I'm kind of thinking that, you know, the supervisors probably knew something that, you know, as to what this was around. The problem is that, so roughly 40% of the equity in the system was tied up in assets whose value was pretty, put your finger in the air and take a guess. And that's the average, right? So the real worry was that some banks weren't at the average. They might have been at 70, 80, 90% of their capital, their book capital was tied up in these assets that were pretty shaky. Nobody wanted to be lending to a bank that suddenly the next day figured that, you know, had to admit they had a bunch of these assets and the auditors were going to force them to write them down because they really didn't know what they were worth. Banks quit lending to each other, they don't trust each other, et cetera. Well, just to close where we started, was this crisis a black swan? Interesting question. Well, and it's, I've done this for quite a while, David, but you remember this actually. This was almost 3 years ago, May. We had the annual meeting of IAFI in New York, and I was asked to chair a panel. And the title of the panel was, "Where is all the risk?" question mark. I mean, interest rates were eerily low, credit spreads were low, volatility was low. There was this almost this sense of eerie calm, and it was the question, where did all the risk go? Well, I put together a graphic that we put up there as kind of a framework for trying to have a panel discussion around, well, where might risk come from? Where might it reappear? And if I was doing it today, I'd probably revise it a little, but that'd be cheating. This is literally exactly the graphic that I did in May of 2006. This is gratifying because one of the problems with writing a column every month is you have to live with what you wrote 4, 5, 6 years ago, and that's not always a completely comfortable experience, but this one worked out okay. Technological change. The fact that so many things are going on, so much technology is changing, it creates, as we know, we update software, we get security holes that have to be filled. Were we perhaps going to have some mishap because we just hadn't really incorporated all the latest technology in the most effective way and had mastered all the things around the process that were required? Pace of innovation, not just in technology in the more narrower sense, but in the financial markets, in new products, in new innovations in a variety of ways. Were we creating problems and dynamics that we didn't really understand? Product complexity seemed like an area where we could be getting into trouble because the products were becoming so complex we couldn't really grasp and handle the nature of that complexity. That leads, quite logically, to model risk, both pricing model risk and risk in the sense of volatility type risk that is called into question because of the issue of complexity. Liquidity, the possibility that liquidity might fail. Liquidity was plentiful at the time, but we know in the past there have been times when that wasn't the case, and that certainly would be a place that it could, risk could suddenly rear its ugly head. Geopolitical risk, this has always been one of the ways that we get shocks from time to time. Commodity prices, the volatility of commodity prices, oil prices in particular, energy prices in general. Extreme events, in this case I was actually thinking of more like natural disasters. The Kobe earthquake, which had a big impact on the Japanese economy, tsunamis, that kind of thing, that would be completely unpredictable, that might throw certain economies into recession. Volume growth, where in certain instances was the volume of activities growing so fast that we just weren't able to master either the operational sort of underpinnings or the risk assessment underpinnings because of simply being overwhelmed by volume growth. External linkages and feedback loops that might result in things, again, these corrosive feedback loops. Again, one of my pet peeves about stress testing, so much of what you hear about stress testing is comparative statics. But crises don't unfold by, you know, shocking the yield curve by 400 basis points and increasing volatility and reducing exchange rates and see what happens. I mean, they unfold, as we've seen, over months of loosely connected or interconnected, moderately causal types of relationships that lead one to the other. And so that's the kind of process that I think we needed to think about. Operational risk, again, related back to volume and the ability to handle volume. Emerging market issues, related to some extent to geopolitical, but also in some sense just natural resource economies and so on. Effective portfolio management. What it really meant was the difficulty of effective portfolio management. Those of you that read the UBS report to shareholders know it took them weeks or maybe 2 or 3 months to figure out how much subprime exposure they had in every nook and cranny. They didn't know where that was. And I think one problem with these major global financial institutions is, because I used to work for one, they can't get their hands on all the data that are required to get a true picture of the enterprise risk. And I thought that was possibly a problem. Information security. I was thinking in the context of loss of personal details and the reputational risk that would have on a fiduciary and people being unwilling, perhaps wanting to withdraw their deposits because they really weren't any longer willing to trust an institution, and you get that kind of feedback from that kind of failure of information security. Regulatory uncertainty is there primarily. This is 2006. We were leading up to the end of the period of Basel II going into effect, and so regulatory uncertainty seemed to be one. You need to have miscellaneous, or people claim that you thought you've thought of everything, and of course you haven't, so you have to have miscellaneous. And as a nod to Donald Rumsfeld, we have to have our unknown unknowns, which is just to say, think about the things you haven't thought about if you possibly can. Think way outside the box. In October last year, after the whole crisis of Lehman failing and AIG being bailed out and the whole thing, I said, well, which of these boxes do I think, if you'd gone in first half of 2006 and you'd done an offsite and you'd said, here are our activities, which of these things would have ticked these boxes as maybe some source of concern relative to these particular topics? And to what extent would boxes have been checked by the subprime mortgage market at the time? Well, pace of innovation, I would argue, yeah, probably, right? The volume at which we were doing them, the complexity that we were tranching these things down to 1 and 1.5% tranches in some cases, which is virtually a digital. Probably you would have checked that box. Product complexity as well, I think you would have checked that box. Model risk, you certainly should have checked that box if you knew anything about how these things were priced and the fragility of the models, even in the corporate CDOs. Liquidity, again, there was plenty of liquidity in 2006, but that's not something you counted on if you'd stepped back and said, where would we be if liquidity failed? I think that's one of the markets where you would have known you'd have been in some trouble. Volume growth, well, you saw the numbers. I mean, it would have checked that box in spades, right? I mean, we tripled the volume from 2002 to 2005-06, so volume growth was literally off the chart. I think if you'd begun to think through the possibility of, okay, what if liquidity failed, and what if banks had a lot of these things and suddenly they can't value them, that would have probably checked the kind of external linkage box too. I think commodity prices as a possible trigger that could have caused some things to go wrong, especially if you had been watching the home prices and had seen that in fact home price inflation was starting to ease, even though it was still positive in the first half of 2006. That might have been something that would have kind of come off the chart at you. And the difficulty of effective portfolio management, the fact that lots of banks just didn't know how much of this they were holding. It seemed to me, at least you might, in Nassim Taleb's terms, you might have been able to turn this into a gray swan. You might have been able to get some kind of a vague outline or that some things could go wrong and a very fuzzy picture as to maybe this isn't going to happen, but here's a scenario checking all these boxes that does seem like at least is something we should worry about and keep an eye on. So very quickly summarizing, statistical entropy, information can never rise higher than its source, and the source is the data. So when you're worried about whether a conclusion is valid, don't start looking at the mathematics and say, oh, have they done the statistics right? Start with the data. You don't start in the middle. If the data do not reasonably support the conclusion, then no fancy analytics is going to get you to the conclusion if it's not in the data to begin with. Structural imagination, that is, think about some of these feedback things beyond the kind of technical, mathematical, sort of statistical stuff that we do so much of in risk management, and use that imagination to define unrepresented variables or movements in unrepresented variables and begin to track those variables as early warning signals so that you at least are among the first people to realize if things are starting to go south and you'd be able to react to it. Self-referential feedback, the fact that in many cases, I don't know about you, I'm a risk manager, so maybe I just react differently, but if I'm in the expressway and I'm going 75, 80 miles an hour, and I've got plenty of room ahead of me, I'm feeling pretty comfortable, somebody pulls up in front of me and cuts my distance to the next car dramatically, I just start to feel a little more uneasy. My instinct is to step back a little bit, to ease off the accelerator a little bit. Unfortunately, in financial markets, when things get going dramatically favorably, our instinct is that, oh, that's great, I got to get in on that party, and like it's going to go on forever. So think about the fact that if things are really growing dramatically, there's probably stuff going on below the surface in terms of dark risk, which ultimately, at some point, recognize that it's creating things which may well undermine the very success. And at some unpredictable point, if that stress gets big enough, you can get a very major change, not just something you get out of 2 standard deviations off daily volatility. Complexity and dark risk. Complexity, especially when combined with limited data, inevitably gives you an area where you cannot do very solid analysis. And there's just some fundamental uncertainty that cannot be eliminated, so just be careful of those situations. Finally, second means of uncertainty, when there's plenty of liquidity, prices are clear, nobody really questions your financials. When liquidity falls to a trickle, when prices start to get a little fuzzy, it becomes something where the values you put on your financial statements become much more questionable. And that's where I think you can get a lot of these things, basically leading one thing to another. And I think my conclusion is you shouldn't only be limiting your holdings of level 2 and level 3 assets as measured today. You should be thinking about where would you be in the absence of liquidity, and if you would be in a very, very tight spot, then those things should be limited too, relative to the proportion of capital. I just this past week came across a quote, which I thought I have to put this on the last slide. Now, I think this is a marvelously eloquent summary. It's a quote from the latest book by James Lovelock, the ecologist. And he's complaining here about the lack of empirical testing and generation of data in ecological studies. He's saying observation in the real world and small-scale experiments on the Earth now take second place to expensive and ever-expanding theoretical models. The next sentence, one I love. Our tank is near empty of data, and we are running on theoretical vapor. Unfortunately, I think in financial markets, too often, we find ourselves in that situation. And I would say if you look around and you see a situation that seems to fit this quote, then be careful. Thank you.
We have some time for questions, and I'll ask Paul to join us here. I have a few jotted down here, but I really like to let you ask questions. We had very good speeches from different perspectives. See if we have a courageous first question. If you want to use the mic, I think you need to push the button. Yeah.
My name is Malcolm Cheshire. I'm a consulting practitioner in human dynamics and risk. My question to both presenters is, what do you feel the role of intuition has in the management of risk?
I'm inclined to think it's very important. It depends on how you define intuition. I wrote something having spent 9 years as a macroeconomic model builder and forecaster in 1982. Actually, this is one thing I sent to Nassim, and he said, "Oh, that's pretty insightful," which I thought was, that was a high compliment from Nassim to anybody that does econometrics. It was called The Role of Models in Economic Prediction, and part of my point was, having done this for 9 years, was that, in my view, at most 20 or 25% of any econometric forecast was the result of the model. Well over half to 3/4 of the result was your thought process around what's unique about the current situation that is different from the average past, which is the only thing you're ever going to be able to encapsulate in a model to begin with. And so, I guess my sense is it's very important, and I think we have, to our discredit, we have tended to sideline intuition. Now, part of this, and I think we had a lot of people come into the business from physics, from electrical engineering, from the hard sciences. Well, generally in physics, you don't blend your intuition or your judgment. I think maybe the atom might move this way. I mean, you do objective scientific things, you gather the data, you run experiments, you try to replicate the experiments. The idea that you blend intuition or judgment with the data is kind of anathema to people coming in from the hard sciences, and it takes a while to get beyond that. And I think in too many cases we haven't. That's one of the nice things coming in from macroeconomics, because you know from the beginning that's the air you breathe. There's no other way to get on with your life.
Paul, do you have a view on this?
I agree completely. There's a great quote from Einstein about imagination being more important than knowledge. But the thing that worries me is that the people who do risk management don't necessarily have the imagination or the intuition, or it's somehow bred out of them. I see that as a problem, because when I first started working in quantitative finance, as I said, before the '87 crash, you could do anything. You could do any kind of mathematics you wanted, and it was all respected. I dabbled for a while in chaos theory. I equally dabbled in technical analysis. I'm now fairly classical, but people are trained in a certain way. This is how you think about quantitative finance, and if you don't think like this, then there's no role for you. I talk about the measure theory police in that context. This is how, and I think that's terrible. I think there is a role for intuition, there's a role for imagination, but it's not encouraged, shall we say.
Do you think that we've become fixated on evidence, and that perhaps has displaced the acceptability of intuition?
I'm sorry, base it on?
Do you think we've become too fixated on evidence, and that has displaced the role of intuition?
Well, I don't. You said evidence, right? Yeah, I don't distinguish the two. I mean, one of the things I like you, I agree a lot with Nassim. One of the things Nassim is claiming to say, we can't use the past to predict the future. And I say, Nassim, I'm sorry, we have nothing else, right? I mean, the past includes black swans, right? That's part of the past we have to try to internalize in our thought process and realize the limits of our ability to predict. But the past is all we have to go on. That said, I think judgment is shaped by evidence. The problem is, I think, too often we've narrowed the range of evidence that we are prepared to admit to the conversation. And thinking about it in the corporate context, I think effective risk management, and my sense from what I read about Goldman Sachs, for example, is that there is a kind of continuing high-level dialogue that goes on among people that respect each other near the top of the firm that is sort of what really needs to be done. I mean, if all you do is run VAR models and get a number and say, oh, it's not too much off what it was yesterday, we'll put that in the file and I'm asleep tonight. I mean, that's not enough. I mean, because it's this whole dark risk issue that's building up in the crevices that may explode in your face, and you don't even know it unless you at least think about some of the structural implications and some of these broader issues.
I have, if you read my blogs, you'll have seen an example where I talk about a magic show. I don't know whether this rings any bells. I'm not going to do this here. Do you know it?
No, I don't.
Okay. And that is designed to pick out who is good at out-of-box thinking. I'm kind of a bit fed up with that out-of-box thinking phrase, but I don't know what else there is other than lateral thinking. But it is desperately necessary, and not everyone can do it, I'm afraid. I don't know whether you can be trained in it or whatever, but yeah, thinking. We have only got the data to go with, but you can think of wacky, off-the-wall things, and those wacky, off-the-wall things will happen one day.
So if you have another question in the audience, or one there.
Yes, I have a question to both presenters. I am August Getsup. I work as a risk consultant. Basically, my question is about how do you see the risk manager role changing as a result of this crisis? Some people have said that the ultimate risk manager is the company CEO. And what's your view on that? How traders, for instance, and risk managers are going to be interacting in the future?
Well, risk management always seems to come as an afterthought, is the impression I get. And here I've got to do a little plug for the certificate in quantitative finance. You've all got the brochures in front of you. You plugged your things. In that, we treat every level of this business, every aspect of this business at the same level in terms of we have all these models for valuation, we have numerical methods, and we have risk management and model validation and all these things. We just treat them all at the same level. We don't say, oh, we've got all this fancy mathematics, and then, oh yeah, we've got to do a little bit of risk management, and you do some dumbed down silly things. I'd like to see all of these things addressed simultaneously rather than farmed out into different groups. I don't know whether that's realistic or not.
Again, a bit in the context of what I said before, I think we have narrowed our focus in too much of financial risk management to doing very kind of mechanical things, gathering data, calculating volatilities, correlations, creating a VAR number, and thought we were doing useful things. Well, I happen to be one I don't disagree with. I think VAR was a big step forward. I was around trying to control trading activity before there was VAR, and it was not very pretty. So I think VAR is a very valuable step forward for preventing traders from taking positions that will take a firm down even in situations that wouldn't remotely be called a systemic crisis. And I think that is an important job of risk managers. Nassim seems to dismiss that, but I think it is a very important job because firms have failed over the last 15, 20 years because traders simply took positions that were too big relative to their capital, and yes, you got a big move that took them down, but it wasn't a systemic crisis. So that is important. But we forgot the second job, and partly because it's been so long since we had a truly systemic crisis, but analyzing the severe tails of the distribution in terms of not just size, but why might things take us down? Where might we be vulnerable to a big move? And think of ways that we could at least truncate that tail. What I think it means is that I think in the better firms, risk managers will become more part of a senior management dialogue, not just around sort of technical kind of enforcement of limits, but around broad strategic issues that hopefully you can make judgments based on, as Paul says, a wide variety of information, including things from fairly technical risk-type models, but hopefully with an understanding of where their limitations are. I think one of the ones, my column that was passed out, was the danger of two cultures. And this whole point of having quants that are off in a corner building models and producing results that nobody really understands the nuances of it, but these other people are making the big decisions about whether to crank up the risk based on this model. And I mean, that separation of these two cultures is a very dangerous thing. And I think overcoming that is kind of one of the jobs we have to try to accomplish.
Thank you. Let's see if there's one final question. We're running a bit out of time. Final one there.
Tang from Fitch. Question to both speakers. Both speakers mentioned the importance of feedback. I just wondered if you all could comment a bit more on how we could incorporate feedback into the valuation process for derivatives from a very practical operational perspective. would that be very different from, looking at accounting for systemic risk?
I'm sort of laughing because it's like saying, well, look, we know all this trading is going to cause a stock market crash. So how can we build, how can we profit from the stock market crash that we're going to cause? There are things you can do, but you want to stop the feedback, I would think, or you want to stop, because feedback can do two things. It can decrease volatility or it can increase volatility. It depends, technical terms to do with whether you're hedging or replicating long or short gamma. The classic example being that if you're hedging convertible bonds, long gamma position, then that decreases volatility, and it has the effect of it gets rid of it eliminates any arbitrage that you were trying to make money from in the first place. Also, the feedback is bad for the convertible bond arbitrage people, but it decreases volatility. But then there's the other feedback which can increase volatility. That we want to stop. So that's a question, not really how you can build it into your models. You can build it into your models. I can show you how to build it into your models, but I want you to stop doing it.
I guess the comment I would make is one thing about spending 13 years as an econometric model builder and forecaster is it develops a fairly substantial cynicism about what you can do in the context of a technically well-defined model. And I think the reason is that in that sense, exactly where something breaks and exactly how it unfolds tends to be somewhat unique. I mean, it's the old quote from Mark Twain, that history doesn't repeat itself, but it does rhyme. And I think there's probably not enough correlation in just the rhyme to make it work in a model, but if you listen to enough history, and partly it's one of the few benefits of getting older, is you develop a kind of better tuned ear for the rhymes of history. There are things that you will begin to see, and I mean, some of these feedback loops I think just have to be dealt with judgmentally rather than trying to get them baked into specific models, quite honestly. Just to give you a quick example of that rhyme of history, some of you will remember 1994, one of the notorious swaps that Bankers Trust sold to Gibson greeting cards was a fixed floating interest rate swap where Bankers was paying a fixed leg to Gibson greeting cards at an above market rate in exchange for a floating leg paid by Gibson, which was driven by LIBOR squared. If you work through the math, you'll find that that floating payment rises twice as fast as a normal floating leg if rates spike higher, which is, of course, why they were getting above market rate. But, of course, the thing that was obvious to a reasonably naive counterparty was they were getting a bigger fixed payment, and they were paying a floating payment that seemed like a floating payment, and they didn't quite fathom the nature of the risk, which is why they were getting a bigger return, but that's another story. When I started to hear about CDO squareds in 2005 and started to figure out, really what was going on in this market, and I thought, that sounds a lot like something I've heard of before. I mean, it kind of rhymed with the whole sort of CDO squared LIBOR swap, and I'm thinking that's just complexity for its own sake. And it's more stuff like that, I think, more than trying to build it formally into a model, that is probably what we need to be thinking about doing.
On that note, let me show you you're in agreement with me that it was a very, very interesting seminar. Now, drinks are outside. If you're lucky enough, our two speakers may be hanging around with us for a little while longer, so you may ask a few questions to them, additional questions you may have. Let me ask you all to join me and thank them again for this most interesting talk.